All right, everybody, it is Thursday, June 23rd. So we had a good move, positive move into the close today. They tried to knock it down a couple of times, but good trading action, closed strong. And happy to report the fiscal looked pretty good, the latest data from yesterday. And I told you this in the video I made yesterday, that data was going to should be strong. We had a Social Security payment yesterday. So it was like a 42 billion day with a net positive fiscal flow of 13 billion. All right. By that I mean if you take the total spending of yesterday minus the taxes, we had a positive, an increase, into the economy, liquidity of 13 billion. So we're back up to 60 billion on the June deficit. That's good. I mean, that's the highest now since a week. That's the highest in a week. All right. It's still below where we ended up in May. May ended up, if I remember correctly, with about an 86 billion deficit for the month. But we still have days left in June. The takeaway from here, from this, and it goes back to, what I've been saying, is that it looks like the worst is over, at least from a liquidity drain standpoint. I've been talking about how, it's really been frustrating that June we saw another big drain because of the quarterly corporate tax payment, and then that kind of lingered on. It wasn't just a June 15th thing. That carried all the way through through Tuesday the 21st. But now it looks, and I've been saying, once we get through that, then I think it's going to be relatively clear sailing from a fiscal flow point of view until mid-September. And I think we're finally getting into that positive flow that's going to be uninterrupted. So, we went through some rough period here. We went through April where, you had a big surplus. They ran a $323 billion surplus, the federal government. That was a huge drain. Half of May was in surplus. That was continuing the drain. We finally got some positive flow in the second half of May into the beginning of June. Then we got hit again with that quarterly corporate tax payment. So it was like boom, boom, one after another. You could actually go back and look at market action leading up to that April 15th tax payment. And it was trying to, it was trying to stabilize. The market, and I think if you go back and watch my videos, I did say, that we're trying to stabilize and we'll probably head higher. I did not. And I should have been aware of this. I knew about, of course I knew about the April tax filings, and I don't know, I wasn't paying attention to the June quarterly corporate. Anyway, it's over. So now the flows should be positive, and I think given that fact, you've got to revert now to a buy the dips strategy, okay? Whenever the market is down during the day, I don't know if you trade indexes, or if you have your favorite stocks, or if you're just looking to accumulate stocks now at these levels, which I think are very attractive levels, then you wait. During the day, you're going to get these dips. Again, this is not going to be, we're not in an environment like we saw over the last 2 years with the pandemic, with massive stimulus going in that's just going to push the market straight up. This is more or less, call it a normal environment, a little bit even on the weaker side of normal, because if you consider the slowdown in the fiscal relative to what was happening last year and the second half of 2020, it's kind of like it is a slowdown in the fiscal. So you're going to have your opportunities. I would not, chase after anything. When the market is down during the day, I would use that as a buying opportunity. If there were stocks that you were looking to buy or add to your portfolio, now's the time to do it, and be patient and buy those on days that they're down or days when they dip negative or unchanged during the day. If you have short positions on, if you have hedges like bearish positions to hedge against a market downturn, I would advise lifting those hedges, and you do that when the market is down so you get your best price on that. Looking now at the 10-year yield, at bond yields are coming down, and I think we're going to see a negative print in second quarter GDP. I mean, it's not going to be a severe negative. I think we're going to get it. It's going to be like the token recession that everyone was waiting for, because that's the accepted definition of recession, 2 negative quarters in a row. I think we're going to see that. But the fiscal situation is, I think there's enough there to, keep the economy. Once we're going to pull out of this negative dip, this second negative quarter, and I think we're going to probably see very low levels, but it's going to be positive, but low levels of economic growth, and that's going to result in kind of like a slow recovery in the stock market. Again, I'm going to say this at least until September. September, we're going to have to deal again with another quarterly tax payment and the budget process, right? I mean, Congress is going to have to come up with some kind of a funding bill. But I'm not worried about that, because they're going to be adding on to defense. So that's going to be positive. And hopefully by then, hopefully by September, we should be in a situation where the Fed is doing its full, $95 billion a month in QT. We still, today, by the way, today was another record in the reverse repos. So it just goes to show you that, we need more help on the reserve side. I mean, you need more reserve drain. And if you get that, I think it's going to be positive for loan growth, which already right now is very strong. I mean, loans are growing at the fastest rate in 2 years. And but once the Fed gets rolling with its QT, I think the bank credit growth is going to accelerate, and that's going to be another support. That's going to be another positive. And I know there's been a lot of mention of record levels of credit card debt and this and that, but again, I'll point to the fact that debt service burdens, in other words, how difficult is it to service that debt? Can people make their monthly payments? Debt service burdens are still historically low. It's about 9%, 9.5% of GDP. The all-time record high of debt service burdens was back in 2007, when it peaked out at about almost 14% of GDP. So we're still well below. And the fact that bank credit continues to grow, the fact that loans continue to increase, is also reflects the fact that credit worthiness is still very strong. I talked about that. I mean, banks love to make loans. We know this, but they're only going to make loans to credit-worthy individuals or entities. I mean, if you don't pass the test in terms of your credit worthiness, that means your credit score, your income, your outstanding debt. Even if they want to make the loan to you, they're not going to be able to make the loan to you. So the fact that loans are going up, even though we hear, everybody talking about record amounts of credit card debt, the fact that it's going up, I think reflects the fact that credit worthiness is still very high. That's a good sign. That's a positive sign. So once again, to sum up, was a good day. I think the trading action today is more evidence of the market bottoming out here. We saw finally a positive fiscal flow for the day. The deficit for June is back up to 60 billion. That's the highest in a week. It's not a big deficit for the month, but the month is not over. We still have several statement days left on the daily treasury statement, so we should probably should end up somewhere like we did last month, around 85, anywhere from 85 to 100 billion on the deficit for June. You know, the deficit equates to a positive addition to the financial balances of the non-government, the economy. So it's looking good. I think right now it's bullish mode until mid-September, and yeah, that's the update. That's the update for today. All right, everybody. See you tomorrow. Bye.